Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and worked until 5:30 this morning to get the latest newsletter out, the March 2019 newsletter. If you're new to us, newsletters come out at the end of the month, or they're dated in real time. Also, there is a sale that all of you should have already seen about taking profits on CHL. That's in full detail there. In this one, I give a new pick, so make sure you don't miss that, which is SLV, the silver ETF. And also, I talk about one of my most widely used indicators, risk barometers, and why it's so valuable to me. And I give you a lot of examples on this one. This one's full of quite a few charts, and I give you a lot of reasons why I'm bullish on SLV, because you have to kind of approach it from a different angle, because it's it doesn't have PEs and market caps and book values and things like that. So you have to look at more from a technical and sentiment perspective than you do a fundamental perspective. Also, I've got our new pick down. By the way, you can click on these and enlarge them. So I would encourage you to check those out. I've got your averaging down points for the new pick. We got in at 1410, which wasn't high, wasn't the low of the day. I picked something that's kind of a happy medium, because I always want very realistic entry prices, very realistic exit returns. That's why I ask you to report in what your returns are, and I kind of pick a mid-level there. And I realize that I could juice up the returns and have things look better by going off of some of your higher returns. I try to be very realistic in what people realistically have made on average. So, and then our China Mobile is in there as well. Took an average of 16.5%. Some of you reported returns as high as 22, 23%, but around that 15, 16, 17% was very common. So anyway, I'd encourage you to check that out. For all of you who have donated and put in for option reports, I have emailed all those out. So if you have donated and you have not received that for any reason, let me know. Post on the site and give me where to send that, and I will send that to you. So with that said, let's get on to our latest pick, which thankfully SLV, we got in on a down day. This one had pulled back. I waited for it to pull back closer to its 200-day moving average, and after a golden cross, and we happened to get it on a day when it's touched its bottom Bollinger Band too. Now, it doesn't mean that it has to necessarily stop there. Matter of fact, it could easily drop further. So I'm not saying that it can't. It could always drop down further before heading higher. So just know that is the case. We're not claiming to call the bottom here. We're claiming that this is at a point of great value, and it's on the weekly has come from 48s to 13s. It held 1304 here, 1311 here. So far that's a higher low here than here. So this would be A, B, C, wave 1, 3-wave pullback, wave 2, and going into wave 3. Now that's the way I've got it counted thus far. However, I have also got us positioned to where even if I'm wrong in that count, and for some reason we head lower before heading higher, then we've got provision there as well, because that's where we've got our averaging down points. So we're in at 1410, then we can be in again at 1150, and then we can be in again at 9. So where do I get areas like that? Well, here you've got some supports around the 11ish or so area, and then you've got some 955, 845. So I'm just kind of splitting the difference there. You've got some support there as well. And also, so I go off of where previous long-term supports are, and if those are gaps big enough percentage-wise to make them worth the investment and of average, bringing down your average break-even cost enough. So that's how I factor that on any asset that we're in. So SLV, again, very pleased with where we are in that. The S&P 500, let me get that typed in right. Still very far away from its 200-week moving average. It shows one of the biggest risks. But look at this declining RSI that's steadily declining. Look at this steadily declining MACD. Look at these big sell spikes that are happening at these elevated levels. These are all big time signs of more decline that is likely to come. And then look at the when the price gets a decent amount above the 200-week moving average, it tends to decline at least to it. And when we're at the end of a 5-ways move, it tends to decline well through it, which here's your last ABC downtrend right there. And then 1, 2, 3, 4, 5. And now we are likely at AB, and then probably have some very long C that takes us somewhere into the 1400 to 1900 area, which I talk more about in our most recent newsletter. So expecting the market to have some tough times ahead of it. Doesn't mean that it has to start tomorrow or something like that. Of course not. It doesn't. And, it's funny. Somebody asked me, "What do you think the market's going to do tomorrow?" Or "What's this going to do tomorrow?" I'm like, "Gosh, flip a coin." I mean, there's the market is subject to so many influences in the near term. I mean, mutual fund or pension inflows or outflows, analyst upgrades, downgrades, news events, somebody, reports on something on TV. I mean, any fickle thing under the sun that has nothing to do with fundamentals can happen on a 1 day or 1 week or 1 month basis. So very near term, it's always hard to call what happens. And so, could the market go, up some more before heading down? Sure, it could. Or could we, we've had this period of consolidation over the last 3-4 days where this is kind of triangulating up over the last 3 or 4 days. So, could it break out to the south side? Sure, it could. And in the near term, we don't know which will happen. We know long term things head lower because of where the price is relative to its 200-week moving average, and more importantly, because we know how elevated the stock market is overall, with the S&P 500's PE ratio being so historically high. So we know those PE ratios have to compress and come down in order for the market to sustain the next up move. And in order for that to happen, the P has to fall relative to the E. The price has to fall relative to the earnings, because the earnings can't turn around and just jolt up to where the price is, because it takes time, TIME, to sell products and deliver services. And so that's why the price has to fall towards the earnings rather than the earnings being able to do a quick catch up to the price. So let's go through our positions. Obviously, if I'm bullish on silver, I'm still bullish on gold. And you know that I'm still long-term bearish on the dollar for reasons that I talk about in the newsletter. So I won't go into that. We could see gold head back closer to the 200-day moving average before heading higher. That's a possibility, or we might be at the pretty much at the pullback and head higher from there. Any of that's possible. We are in a 3-wave pullback. So it would not surprise me if it pulled back at least to the Bollinger Band or towards this 200-day moving average before heading higher. And keep in mind, these moving averages are just regions, so there's nothing that says it has to stop exactly at the moving average. It can overshoot it a bit or something and head higher, and that's nothing unusual about that either. So just know. But very bullish on gold. I believe it's a great place to be with the uncertainty in the world, with slowing global and U.S. economies, with an overvalued dollar, with an overvalued U.S. stock market. Lots of reasons for that I'm bullish. FXB on any given day, your guess is as good as mine on what's, whether there's further progress or not on Brexit vote or not Brexit vote. One day there is, and pounds up. Next day there's not, and pounds down. But overall, I believe that we have seen a very notable bottom here, and the next rise, and then we're in the next pullback and consolidation right now. Will we have 5 waves sideways, or will this dip a bit further before heading higher? We don't know. It could do either, but we know over time this is likely to head higher. Sooner or later, the Brexit deal is behind them. But even more importantly is that it doesn't take the Brexit deal being behind to put in a bottom in the pound. Markets are discounting mechanisms, and that means once the information is known and has been known about something, the market fairly quickly and efficiently factors that into the price of the asset at hand. So not only is this 121 likely a near-term bottom, but going back on the weekly chart, this 117.48 is likely the real long-term bottom, with this being wave C, this being wave 1, this being wave 2, and us getting ready to head into wave 3. And I know people will think, how in the world could you head up into wave 3 with Brexit stuff still happening? And the deal is that when things go from bad to less bad, you tend to already have the trend change underway. And trends don't change when the news changes. Trends tend to change, and then the news changes. I know it seems not logical, but in reality, that's how things work in markets, and me watching markets for 25 plus years. So we might be at the recent bottom and head up from there, or we might pull back a little bit and head up from there. Either way is possible and probable, and it doesn't matter which one's the case. We still get there. So here is your point of maximum pessimism. Here's your point of next most maximum pessimism, which is dropping down some. But that's another reason why this is likely the bottom of wave C, and why this is likely the bottom of wave 2, because there's 2 of your most pessimistic times in an asset. So speaking of which, former subscribers have held SLV for a bit now, and most of you have it at fairly low levels, but you've had to wade through this somewhat sideways period, which this is an A, B, C. So the bottom in silver, if I'm correct, if these lows hold above that, the bottom in silver would be here at 1304 at the beginning of 2016. Here would be wave 1, and then here would be a 3-wave wave 2. So it seems like silver has gone nowhere from the way that it feels. And somebody had commented on I'm getting tired of waiting and stuff like that. And I would encourage you not to have that type of thinking, because that's practicing novice thinking. You never turn loose of an asset just because you happen to be tired of waiting. You turn loose of an asset because it's fundamentally flawed, fundamentally bad, things like that. If that's not the case, then you hold on. And if for some reason you're having to sell because of something that likes dictating, then you're not factoring your emergency fund and reserves correctly before investing. So I would say that to that. I'm looking for this to head higher over time, but like I say, could it head back some before heading higher? But note the sentiment in anywhere in the latter stages of wave C through wave 2. Sometimes you, as my subscribers, are the embodiment of that, as much as I try to teach otherwise. So just realize that that's how real Elliott waves are, because even out of your own mouths and out of your own thought processes, you epitomize wave C and waves 2. And so learn to counteract your natural way of thinking. Never ask yourself how you feel about a stock, because the way you feel about a stock has nothing to do with how a stock or ETF will do. If you look at the last 5 stocks that we sold, probably most of you wouldn't have gotten into Foot Locker because it was retail stock, and retail supposedly sucks and it's dead out there, right? And we wouldn't have gotten into Brazil because you know how bad Brazil's been. I mean, BRIC stocks, which is Brazil, Russia, India, China, they've been dead for years, right? So no need to be in those, and we had a great return there. Sienna, a tech stock that had been dead for many years, and we got in it, and it took off, and we did well in it. LB, another one that it was in an unfavorable sector, and people wouldn't have gotten in because after all, the media was touting how horrible it was. And then CHL, China Mobile, a lot of people, it probably wouldn't even come up on a lot of people's radars in America, because when they think mobile carriers, are thinking AT&T and Verizon and Sprint and so forth. So that came up and came as a value and even a nice dividend yielder, and that one did well for us too. So my point is that you probably wouldn't have, by feeling, gotten into any of those, and by feeling you would have not experienced any of those profits either. So feeling has nothing to do with it. Matter of fact, the worse you feel about it, probably the more poised it is to be turning around in the future. And the better you feel about it is when really you should be second guessing yourself. How do you think people felt about silver right in here? Pretty darn good. I mean, after all, it was just going straight up and parabolic move, right? They couldn't get enough of it. And this huge buy spike right here, right before this huge sell spike, shows and proves that. So, I mean, they've got almost 800 million shares net bought in this week, and they can't get enough of it. And so you couldn't get them to buy it at 19 or 20, and you can't get them to not buy it. They're just buying it without abandon at 40, 42, 45, etc. And lo and behold, it goes down to 13. So the way you feel about stock has nothing, literally nothing to do with what it'll do in the future. So FXB I'm very bullish on. I expect it's a very negative sentiment play. It's a very overly pummeled play, and it will also benefit from the fall of the dollar as well. EWW is one that had corrected severely and now has rebounded in a V-shaped bottom, and now is consolidating a bit. Near term, we never know. Near term, it could be done consolidating and head on up, or near term, it could even pull back a bit deeper before heading on up. Either way, no big deal. Doesn't matter to us. We know that it's cheap fundamentally, so we know long term it heads this direction, even if it goes here before here to get there, or if it just goes straight there because it's already had some consolidation and pullback. Either way, doesn't matter. Sometimes people get caught up in trying to figure out every little wiggle and squiggle on the chart, and that's unproductive to do. It's better to see where the asset has to go long term, based off of how solid the asset is fundamentally, how cheap it is fundamentally, how assets don't stay cheap forever. So if they don't stay cheap forever, they end up heading upward, and accounting for that and going back to more fair and even later on overvalued levels. So we know where EWW goes overall. Incidentally, too, Mexico has been a beneficiary in the U.S.-China trade war as well. Bloomberg just did a story on that. So even they're benefiting from, the spats between the U.S. and China. GDX, another one that is doing well. By the way, it was really neat. A subscriber reported that he had gotten my options report and options book and was using one of the strategies trading GDX. So he was using one of the LI picks that was trending higher and that I was bullish on. And so he already knew it was screened as a good asset because it was in our LI portfolio and it was trending higher. And so he was using the technical signals that I teach in the options report and had made some, really great gains, 40, 50, 60% gains each time in the option. So, again, it works and it's very helpful. And I appreciate his testimony. But anyway, Golden Cross here, higher highs and higher lows. We are seeing a little bit of a slumping near term. So it would not surprise me if GDX has a bit of a cooling off period before heading ever higher. That can always happen. Could it just tread water sideways and then go up? Sure. Or could it pull back closer to a major moving average or a bottom Bollinger Band before heading higher? Sure. Either one's the case. Either one can be the case. Either one's just as likely. Doesn't matter which one happens. Ultimately, the asset is cheap, the asset will benefit from gold's rise, and the asset will head higher, I believe, over time. So, so very bullish there. After that, we've got LPL. So LPL had broken a corrective line. It's had higher highs and higher lows. Golden cross here, where the 50-day crosses above the 200-day. We're at and really slightly outside of bottom Bollinger Band. Doesn't mean that on each time a Bollinger Band is hit, it doesn't mean that it can't go lower. It just means statistically, about 89% of the time, the price is going to stay within those bands. But occasionally you'll have one come out of it for a short period and then go back higher. So either way you slice it, again, I'm looking for this to continue. RSI is oversold again. MACD overall is heading higher. So things are looking good overall for LPL. Very bullish on it. Then next we've got BBBY. You get it typed in right. So this one had a massive gap up and pop higher the other day. It's funny, the people that are believing just carte blanche that retail is dead. Certainly there is some truth to some elements of retail, being dead, no doubt. There's obviously places that are closing some stores and closing up shop and that sort of thing, but it's not just going to be Amazon, Walmart, and Target or whatever make it and everybody else goes under. I mean, it's just that's taking a truth to an extreme. And when it becomes an extreme thought, then it becomes false and not true. But investors invest in it with that extreme viewpoint. And so I said, that's a bunch of junk, and that was not likely the case. And so I believe investors had it wrong, and so we invested, and then we got our averaging downs in. And so now we're on the rebound from 10s to 17s, 18s in just a matter of a few months. Now, this has had a massive gap higher because there was some activist investors that are looking to turn over the entire board of Bed Bath & Beyond, and hey, maybe that happens, maybe it doesn't. Doesn't matter to us either way. This could close part or all of that gap before heading higher. It could have something shallow and then head higher, or it could just go sideways and head higher. Any of those are likely outcomes, and we're fine with any of them. Obviously, the shortest path there would be nice, but in investing, we know that things wiggle up and down, and there is almost no rhyme or reason near term to what happens, but long term, we know where things are going because it's fundamentally cheap. So MACD has been heading higher, RSI has been heading higher, but it's slightly overbought. We are at the top of a Bollinger Band too, so again, we could see some recoil from that. Look at these massive buying spikes here. So here's what's amazing. So investors were selling it just like crazy here in the 12s and 13s. And then, and this is retail investors because they're the ones selling and all frustrated. And then who comes in and buys in mass near bottoms? That's institutions. And so institutions come in and buy big time on the backs of some of the biggest retail selling that happens. So they're picking it up in the 12, 13s, 14s, and it's already been as high as 17s, 18s, and will be going much higher into the future. We will probably look to sell this one around probably the 20 mark, somewhere in there. So just so you know, in my mind, what I'm kind of looking at. That's always subject to change. Of course, that could change, but right now, that's what I'm looking at. Let me get that typed in there right. So CAJ broke a downward trajectory. It's got an inclining 50-day moving average. Got a RSI that is increasing as well. Here's your point of maximum pessimism here. It's been dropping off. MACD's been heading higher. So things are looking good there. This one, it wouldn't surprise me if it, breaks out and starts holding above its 200-day moving average in the coming months. So, it might have some more pullback, but I'm expecting eventually it to start sustaining itself above the 200-day and head on up. So very pleased with how this one is turning around and doing. And again, very glad that we are in that stock. And then we've got IBM, Big Blue. This one's not wanting to cooperate with me. This one, people were selling it just really recklessly in the 111s, 112s, 104s, etc. And mere months later, it's back to 140s, 139, 140, 142. And so people do the dumbest things at the worst time possible. And that's why just because everybody's doing it doesn't mean you should be doing it. Matter of fact, usually it means you should be doing the opposite. So many times you'll find when there are massive selling volume spikes that are 2 to 3 times or more the average selling volume or average daily volume, that the masses are typically getting it wrong, and that there will come a day, usually in the not so distant future, where it will go notably higher. For instance, they were selling it recklessly here about 133, 135. Mere months later, it was at 150.66. Here they're selling it recklessly at 111, 113. Here at the 104s, 105s, 106s, and then here it's 140, 142. Mere months later. So, by the way, how do you think they felt about the stock here? Did it have any bearing on what it was going to do in the future? How do you think they felt about the stock here? Did it have any bearing about what it was going to do in the future? So, I just learned to just discount bad feelings and not even ask myself how I feel about a stock. How I feel about a stock is regardless, it doesn't matter. So I go back to, if anytime I'm ever second guessing something, what I do is my default thing is, okay, let's go back and look at fundamentals. So I go back to Yahoo Finance. What's the market cap? What's the earnings? What's the cash? What's the debt? Is there a dividend? Blah, blah, blah. Is it fundamentally sound? Is it fundamentally cheap? If it checks those boxes, why am I worried about it? So I sit and be patient and let the market bring me my return. The market determines the time frame of our return, not we don't. We determine the quality of our entry, which can help determine how long we're in it. And that's why instead of us having a 5 to 10 year horizon like the brokerage industry teaches you if you're a true investor, we have honed that down to an average of 2 to 4 years, sometimes being a little over that, sometimes being a little less than that. So lately you've been spoiled into having a lot less than that, having sales in 6 months or a year and a half or something like that. And again, like I said in my newsletter, don't think that I'm more on my game when the market happens to hand us our returns quicker, and don't think I'm more off my game when the market takes a little longer to get there. It's the same system, same thought process. I'm consistent as the days are long. I'm not easily moved or fickle. I don't get emotional about it. It's very much numbers driven, data driven. So the system stays the same. I stay the same. But the distance and length of time that we'll be in an investment, only the market determines that. I can't tell you in this stock will be 6 months and this stock will be 3 years. If I could, I'd only pick 6 monthers, right? Who wouldn't? I guarantee you on the stocks that we've sold already, I wouldn't have picked them to be some of our first ones sold, and I would have already picked some others to sell out faster than that. So I also don't try to pre-guess which stocks are going to hit targets first and which ones are going to hit later, because that's a crapshoot and you're very apt to be wrong. So since I know that that's a guessing man's game, I don't spend a lot of mental capital playing that game. I focus it on long-term fundamentals. So IBM looking really good, big rebound. Now just know that since it's gone from 104s to 142s, everybody gets thrilled about the upside volatility. But if there were decent sized downside volatility before heading higher, that would be normal too. And it's the downside volatility that scares people and gets them to second guessing. Why? Because they forget about how markets work. They don't just go straight up. So if you're expecting this, you've got wrong expectations. Markets don't just do that. It'd be nice, but fantasy and reality are two different things. And and I'm not saying, 1 out of 1,000 stocks that you ever invest in or whatever, could it do that? Sure, it could. But the typical and the norm is what you need to set your mindset at. And when something goes from 104s to 142s in the span of like 90 days or something, the logical head on your shoulders needs to say, it would be very practical for people who have been in this from 104s to 142s to want to take some profits and cause that to dip to some degree. And it could even be a sizable dip because this move was so huge before this thing resumes. So just know that is highly possible and highly probable. So a lot of investing is setting proper expectations. And if you set expectations properly, then you'll have less frustrations. So I talked about that in one of our monthly newsletters. By the way, if you're new to us, I would encourage you to go back and read every previous monthly newsletter, because in every monthly newsletter, there are timeless philosophies and thought processes that I teach in there that collectively is like, in my opinion, getting a college education on the stock market. In fact, even better than that, because professors don't know jack when it comes to the reality of actually investing in markets. But watching them and being involved in them for as long as I have has taught me more than any college professor can ever teach you about stocks. So it's really even better than a college education in the markets. So KHC, this is one that we bought at a value and it got to a deeper value. It's still fundamentally solid, does carry a bit more debt for its size than I would prefer, but nonetheless, that's a long-term problem they will have to fix. That will, our holding time frame likely won't, be a big deal with that. It still has a very nice dividend. It's still a beaten down stock in a overvalued stock market, that when money has to rotate out of overvalued stocks into undervalued stocks, they're likely to look at this one. We've hit likely our point of maximum pessimism has already pretty much more than likely come. It was when everybody and their mama sold out here. The selling volume has dropped off big time. So the pessimism is, I believe, done for. I think everybody who was going to dump it did it over these handful of days here. And so I think that makes it easier for the buyers to take back control. Now, with that said, that doesn't mean that this can't dip some further before heading higher. It can. Or it can just tread a little water for a little while longer and then head higher. Any of that's possible. And can it just zip right back up some? Sure. Any of those type of things are possible. And nobody knows in the near term which outcome is going to happen. Good thing is we don't have to. Because we buy fundamentally cheap assets, and because we average down, and because we have patience and set our time horizons properly, we know what's likely to happen 8, 9 times out of 10 with these assets, and we know what's going to happen with our portfolios overall as a basket of stocks that we've bought fundamentally sound and fundamentally cheap. As a basket, they're going to head higher. They're going to do well over time. And sure, we might have one or two not do good here or there. Nobody wins them all, but that's why we diversify, right? That's why we have a basket of stocks and not just one or two picks, and we spread our money around. So our final one that we're looking at is ticker symbol ENI. Of course, there's a battle between Trump and OPEC right now. OPEC wants higher oil, Trump wants lower oil. So there's always that back and forth depending on who's putting out a news announcement and who's tweeting and whatever. But just know that oil is low still. Take a look at it here. It is, here's your latest ABC. Here's a major wave 1. Here's a major wave 2. We're likely in a wave 3, but keep in mind we've come from 42s to 60 awful quick. So could oil, head back lower and come back closer to the moving average here on this 200 week, or even overshoot it a little bit to the downside before? Well, no need to make it that big. before heading higher? Sure, that could happen. So just know that. And because of that, ENI won't likely go straight up either. It will have corrections typically right along with oil. So this one could very well have a decent size pullback before heading higher. Again, I'm not touting an exact stopping point. I'm just giving you some general direction there. So this stock has gone from 29s to 36s in, like 90 days. And it's hitting its 200-day moving average area for the first time in a while. So it would not be unusual for this to have a decent sized pullback before heading higher. That's just how markets work. They go up a bit and they correct. They go up a bit and then they correct. So to not think the correction is coming is just, a novice mistake. Don't expect this to happen and it goes straight there. It just doesn't happen. If you're expecting that, you've got misaligned expectations and you're going to be disappointed a lot in your investing. Also, don't tie your emotions to every little wiggle that's along the way, because if so, you're going to be in for a roller coaster ride your whole investing career. So don't do that either. Set proper expectations. Set an expectancy that it's going to take 2 to 4 years for you to reap your profit. And the few times when it happens to where it's less than that period, say, oh, that's awesome, and just know that's an anomaly and not a norm. When it falls within the 2 to 4 year time frame, say, well, that's pretty typical, pretty average. And then when it's over that, and every once in a while something takes a fifth year or longer to come out of, just know, well, it is an average, and a few of them will be shorter than that 2 to 4 year time period, and a few of them might be a little longer than that time period. The market determines how quickly we get our returns, and we don't. We determine the quality of our entries by buying something fundamentally solid, fundamentally cheap, and then averaging down at prudent points, and then sitting back and being patient and collecting dividends in many cases. So if you think about our average dividend yield, while you're waiting for something, it really can help you a lot with your impatience, because if you just had that money sitting in your checking or savings account, what are you earning? A fraction of 1%, whereas on some of these stocks you're earning 3, 4, 5%, and even on the ones who don't, when you do a blended average, you're still probably earning a couple of percent overall versus having it in the bank. And then one day you get the bonus of having the appreciation to go with it, which is the difference between what you bought the stock at and what the sell price is. And that's where your biggest and real market beating and inflation beating return comes from. So, and meanwhile, you had your money working for you each and every year through dividend interest earned. So anyway, that's a good way to think about it. All right, that is it for this week. Again, check out the monthly newsletter if you haven't already. Check out the sell signal on CHL if you haven't already. Stay attuned to the site. I'm not saying that, because I want you to hear my voice or pay attention to everything I say. But if you think about it, like I said in the newsletter, what else in life literally pays you money outside of your primary job? Very few things in life. You have seen by staying attuned to this newsletter how it literally pays you over time. It literally puts money in your pocket over time to pay attention to what's going on this site. And you'll find the ones that pay better attention, if you'll look at their returns, they tend to be better because they sold at higher prices, because they sold when I told them to and not missing alerts. They paid attention to the charts and they listened to their weekly videos. And so they knew when to average down and they paid attention to that. And so they took advantage of averaging down and thus got a higher return than others did who were in the stock the same amount of time. So if you want to give yourself an added edge of so many percent more per year on your portfolio, pay better attention. While I encourage you to turn your email alerts on, don't use technology as a crutch, because technology has hiccups and it doesn't always work. And when it doesn't, lo and behold, it'll be the time where the stock dropped 5 or 10% on you and turn your gainer to a loss, or turn your 15%er gainer into a 5%er. And so don't be lazy and don't be complacent. If you will invest, put down the reality TV, the golf clubs aren't going to pay you, the video games aren't going to pay you, whatever. Most things in life are not going to pay you. So do something for yourself, do something for your lineage and your heirs, Do something for your church, because that advances the kingdom of God as you tithe off of these gains. It's going to help your church, local church, missions, etc., the poor. It's going to help your heirs. That's productive. That's profitable. That's stewarding. That's godly. So I would encourage you to do that. Thanks so much for watching. Bye-bye.